Good morning and welcome to Managerial Accounting. As we look at our calendar, you can see that we'll be finishing up Chapter 22 today. And so the Chapter 22 exercises should be submitted by the end of the day today. Tomorrow we do have a review session scheduled, the drop-in review session. You can schedule that, sign up for that through Blackboard. Through Starfish by just going to your courses, and when you look at this course, you'll see under my name the link to sign up for that drop-in review session tomorrow morning from 10 to 11. We can use that session to go over whatever people are interested in discussing. My thought for this week would be that we are preparing for the exam that you're going to be taking this weekend. And so we could look at the practice set of exercises for that, but it is totally wide open, whatever people who are there would like to discuss. The exam on chapters 19, 20, and 21 is open for you now and should be completed no later than Sunday at midnight. Whenever you start that exam, you have 3 hours to complete it. You cannot pause it and come back to it later. Remember to open your ebook before you start the exam. And if you have any technical issues while you're taking the exam, just send me an email right away. Do not wait. Don't wait till next Tuesday and say, oh yeah, something went wrong. Just send me an email right away, because probably 4 out of 5 times is something I can help with right away. That would include if you start the exam and then realize you don't have your book open. So if you just stop the exam, I can delete it for you and open the book and then restart. Any questions about anything you want to talk about from the 3 chapters that are on the exam or anything else? Alrighty. Well, if there aren't any questions, then we will get started right away with our work for today. So we're looking at Chapter 22 on budgeting. We spent last class, after we did our preliminary stuff and we had our visitor from Bellevue University, we talked about the process of budgeting, some different types of budgeting, including zero-based budgeting, compared to budgeting that starts with what did we have last year? Okay, let's build from that. And we talked about the order in which budgets would be prepared, starting with sales. So if we're using pull-through production, that concept of efficiency, then we are producing because we think we can sell the product. So we started with a sales budget in exercise 2, I should probably mention. We also talked about flexible budgets, recognizing that as our level of production changes, our variable costs we do expect to change, but our fixed costs should remain the same within our relevant operating range. Then in exercise 2, at the end of class, we were talking about sales. We actually produced a sales budget and a production budget. We noticed that the sales budget includes both quantity of units to sell as well as their selling price. So it includes our revenues that would become part of our pro forma or budgeted income statement. Once we know how many units we're going to sell, then we can project or predict how many units we will need to produce to be able to sell that many. So we're taking into account beginning and ending inventory. And that takes us to the end of what we discussed on Tuesday. Does anyone have any questions about any of that? Anything from Tuesday? All right, well then we'll just keep going. So once we know how many units we are going to sell, we can calculate how many units we need to produce. And from that, we can go into what materials, what labor do we need to support that level of production. And so in exercise 3, we're looking at the direct materials purchases budget, where again, if we had beginning and ending inventories, we would need to take those into account. If it's a brand new company, there may not be beginning inventories. That would be a simplifying assumption that we would make. And if it is, but for most companies, you're going to have both the beginning and ending inventory based on what you believe you're going to need in the next period. And, sorry. Okay. And so that's what we're going to be dealing with in our first exercise for today, exercise 3 in chapter 22. Anticipated sales for Safety Grip Company were 42,000 passenger car tires and 19,000 truck tires. Rubber and steel belts are used in producing passenger car and truck tires as follows. So we're looking at 2 specific raw materials for this budget. As usual, we're looking at a relatively simple product, just two direct materials. You can imagine how for a more complicated or complex production process, everything we do here would just be magnified. So, some products might have literally dozens or even more raw materials, direct materials we would need to budget for each one of those. We have the purchase prices of rubber and steel. They're given to us, and the desired ending inventories and estimated beginning inventories. As I mentioned last class, if we're putting together our budgets for a real company, we would need to know, in some circumstances, what type of inventory system they are using, what valuation method they are using, whether it's FIFO, LIFO, average cost, or specific identification. The implication here is these are the prices that we are going to spend, these are the prices that we are going to spend this period because we're doing the purchases budget. But as we move forward, we would also need to have a direct materials usage budget, which is what would contribute to the calculation of cost of goods manufactured and then cost of goods sold for those other reports and financial statements down the road. So because we are calculating here how much we're going to spend on purchasing those items, we don't need to know at this point the usage. And when we look at these, where are they here? The beginning inventories right here, you'll notice it does not tell us what cost, what we spent for those when we acquired them, but we would need to know that. We would have that information, and we would need to know that as we determine the value of our ending inventories for the balance sheet, the cost of goods manufactured, and cost of goods sold. Questions so far? So as we look at the direct materials purchases budget, we're simply going to start with our calculations. So we have 2 separate direct materials, rubber and steel belts. For the passenger tires, we need 35 pounds of rubber, and for the trucks, we need 78 pounds of rubber. For steel belts, we need 5. We're going to change these numbers. I just want to get them in here so I can do my math. We need 5 pounds of steel belts for a passenger tire and 8 pounds per unit for the truck tires. But how many truck tires are we going to need to make? Now let's figure that out. I'm going to start, annotate up here. So as we look at the rubber calculation for passenger tires, So anticipated sales for passenger tires was 42,000. So I couldn't see up there. Try to put this in. Okay. So if we're going to make 42,000 passenger car tires, and each one of those is going to take 35 pounds of rubber, we will need a total of 1,470,000 pounds of rubber. Everyone agree with that? Okay. And for steel belts, again, 5 pounds per unit for 42,000 units. $210,000. Go ahead and do those same calculations for the truck tires, knowing that we plan to produce 19,000 of those. How do we know we're going to produce 19,000? Because we've already done the sales budget and we've already done the production budget. The 19, whoops, sorry, it is 19,000 truck tires. At 78 pounds of rubber, and then 19,000 truck tires at 8 pounds of steel belts. And we're told that we expect to have we're told that at the end of the month we want to have, where is it? 40,000 pounds of rubber. These numbers are right here. 40,000 pounds of rubber and 10,000 pounds of steel belts. That's in addition to what we need to make those passenger and truck tires. And so for our rubber, we need to have almost 3 million pounds available. This is for the month of December. Oh, it's for the year, I apologize. So it's for the year. So there's the beginning. And so this is our estimated, I thought I was looking at the month, but it says year ended. Our estimated beginning inventory for rubber is 46,000 pounds. So we need this amount for passenger tires, this amount for truck tires, and this is how much we want to have left at the end of the year. So we need to have available 2,992,000 pounds of rubber, but we expect to start the year with 46,000 already on hand, and so we need to purchase 2,946,000 pounds. If it helps you to remember to subtract that beginning inventory, you can use a negative. It does not tell us here whether we need to or not. So the software normally will allow us to use that negative. And then to finish up the rubber column, the purchase price is anticipated to be $1.20 this year. How do we know it's going to be $1.20? Well, we talked on Tuesday about authoritative versus participative budgeting, and I suggested at that time that we need to ask the people who know. So how do we know how much it's going to cost? We talk to our supply chain people. What are you seeing? What do you expect to happen? Do we have any LTAs or long-term agreements in place that we have a guaranteed price? Just talking with someone yesterday, I'm sure you're all aware of the impact of gas prices. We're all seeing that happen at the filling stations. But I was talking with someone who works for a local manufacturer, and And they mentioned that a contract that they had in place for the next 2 years with a set price is starting out about $600,000 in the red because of steel pricing. So same issues with supply chain and increasing prices. And so the quote that they provided to their customer was based on what they anticipated spending on steel. And the steel prices, if you can even get it, the steel prices have gone up so dramatically because of a lack of raw materials that come from countries that are being impacted by strife, war. Yeah, it's not pretty. Whoops. And then finally, we just need to add together. And this number, the total that we expect to spend on these direct materials would become part of our cash budgeting process. We need to use these data for planning purposes. So as we're placing orders with our suppliers, we need to tell them we're going to need 364,000 pounds of steel belts this year, and maybe give them, a month-by-month order, so they can be planning. And so that is a direct materials purchases budget. As I indicated, we would also have a direct material usage budget that would include not just the current price, but it would take into account whether we're using LIFO or FIFO. So if it was FIFO, we would, this beginning inventory right here might have a different value or different cost to it than what we're paying this year. And we would need to take that into account in our usage budget. Okay.
So I don't know if it's technically an accounting question, but the situation you were talking about where they had a contract for steel.
Mm-hmm. Well, they didn't have a contract for steel.
Okay.
They had a contract to build a product that the raw material is steel.
So could that, seen as, I mean, I'd call it an unforeseen price, light and stuff, is there like an out for that, or do they just have to kind of eat the loss?
It depends on how the contract is written. So they have a contract with their customer, and if there's not a clause in there about raw material pricing, I haven't seen it yet, but I assume it's coming, and maybe I just haven't seen it, but you'll start to see surcharges on delivery and freight, that kind of thing, certainly from the gas price increases or the diesel price increases. I am confident that this company is going to be going back to their customer and saying, we can't do it for that price anymore. But it's a huge deal. I mean, obviously, if it's a $600,000 swing, we're talking about a multi-million, many millions, tens of millions of dollars in this project. So, can you afford to make it when you just lost $600,000 off the margin? I don't know what kind of margin they had, but at a minimum, it means they're making $600,000 less than what they expected. Worst case scenario, they're losing money on the job.
And that's right now just the steel.
Mm-hmm. Yep.
So,
Yep. It's kind of scary. It impacts everybody. So as I said, on Tuesday, I believe I said this, the direct materials and direct labor budgets can be prepared really at the same time once we have that production budget, because the information is coming from different sources. So when we looked at the direct materials budget, we needed to know how much each product was going to use. Well, we have a specification or a spec sheet that says, here's how much goes into each one of these products. Who determines that? Well, the engineering or design team say, here's how much goes into each product. The manufacturing team has some input into that. Yeah, we can do it with that much product. At the same time, we are looking at, well, how much labor do we need to produce these items? And who's going to tell us that? And again, there's going to be some kind of a specification. We're going to have expectations about, or standards about how much labor, just like we have for how much material we're going to use. In our next chapter, so next week, we'll be talking about variances, standard costs and variance analysis. And we'll come back to this. How do we know how much material and how much labor it's going to take? But the manufacturing team, the engineering team are going to have some input into how much time it's going to take us to produce the product. And our human resources department is going to be able to provide for us the information about how much we pay our workers on average. So this budget that we're doing in exercise 4 can be prepared along with or simultaneously with the direct materials budget, because the information is coming from 2 different sources. And let's take a look at our direct labor cost budget. So we start at the beginning. Ace Racket Company manufactures 2 types of tennis rackets, the junior and pro striker models. The production budget for July for the 2 rackets is as follows. And as just a reminder, so where did that production budget come from? It was based on our sales budget. How much are we going to produce? I don't know. How much are we going to sell? We need to know that first. Both rackets are produced in 2 departments, forming and assembly. So there's 2 different sources of direct labor. The direct labor hours required for each racket are estimated as follows. So we have this in hours, and then we have their rate per hour. Certainly it could be given to us in minutes, and we just need to make sure that our units are the same. So as long as we have our labor rate in dollars per hour, if this was given in minutes, we would need to convert it into hours to finalize those calculations. So let's start with the junior rackets. We expect to produce 1,500 junior rackets. Excuse me. We expect to produce 1,500 junior rackets, and each one of those rackets, each one of those rackets takes 0.16 hours in the forming department, for a total of 240 hours for the junior rackets in the forming department. And those 1,500 rackets then take 0.24 hours in the assembly department for a total of 360 hours. We expect to make 6,200 pro striker rackets, so go ahead and do those calculations for each department. So we then have our total hours in each department. Oops. And the Human Resource Department has given us the expected average hourly rate. So that doesn't mean that every one of our employees makes $18 an hour in the forming department. It means that's the average. That would take into account any potential increases from overtime. So if we need overtime, that would be included here in this calculation. And so we now have our total dollars that we expect to spend on payroll for the forming department, or direct labor anyway, for the forming department and for the assembly department. These numbers are going to feed into the cost of goods manufactured and the cost of goods sold calculations that we will need to do. They also are going to be, these hours are going to be very helpful for our planners, our schedulers, human resources. So we look at that 1,480 hours in the forming department. We say, well, how many employees do we need to cover that? If this is 1,480 hours for the month, and we expect the average employee to work 40 hours 4 weeks out of the month, okay, divide by 160, that's 9.25 full-time equivalents, or FTEs. We need to have that number of people, that number of trained, qualified employees working in the forming department. As we're looking ahead, if we say, we're not going to be able to do that, we only have 8 employees, we might need to go back and do some recalculations. We might need to include that the impact of overtime on this average hourly rate. If this is a forecast beyond just the month, if this is what we see happening for the next year or longer, maybe we need to look at hiring. Maybe we look at the hours for the assembly department and we say, yeah, we have more than enough people to cover those hours, so maybe we need to cross-train some of our assembly department people, if possible, if it's a good fit, and have them be doing some hours in the forming department. So lots of different ways that having this direct labor budget is going to be helpful. It's going to be used in many different areas, not only preparing the financial statements and the budgets, but also for planning, for hiring, for training, for replacing employees as they leave, or planning for reducing, I think I said on Tuesday, reducing our number of employees to attrition. As people leave the company or retire, maybe we don't replace them if we don't forecast the need for more employees. Any question about that? Direct labor budget. So I am going to, this exercise is a review of what we've already done with both the production and the direct labor cost budget. So I'm going to skip over this for now, and we will move ahead to do the new information. At the end of class, if there's time, we can do this together, or if you want, you can just try this on your own. But for now, we're going to skip over this because it's just additional practice with what we've already done. So let's go ahead to exercise 6. Any questions though before we keep going? So back in chapter 15, when we started this semester, we learned that all products include 3 separate types of cost. Direct labor, direct materials, we just saw budgeting for those. And now we get to that third component of product cost, which is the factory overhead budget. We are given some costs based on the anticipated production for August, and we are asked to put them together in this overhead cost budget. As we have been doing for the past couple chapters, we are separating our costs based on the cost behavior, whether they are variable or fixed. And that is helpful if our level of production for August changes. So how do we know what the anticipated production is? Because we had a sales budget, we completed a production budget based on that sales. We put together these numbers based on that anticipated production. So what happens next week when the sales department says, yes, so we've had a change for good or for ill. We could be that our production needs to go up because we have a new order that we didn't think we were going to get, or that the price of gas and steel has made it so that our anticipated sales are going to go down. So it's very helpful for us to have these divided up based on fixed versus variable because it speeds our efficiency, makes us more efficient if something happens that changes this budget, that changes our anticipated production. What I would like to see, we don't have it for this exercise because it's not necessary, but in general, what I would like to see is a separate column that shows for the variable cost, the cost per unit. And we've talked about in earlier classes the idea of using an Excel spreadsheet so that you can put in formulas. One of the advantages to budgeting in Excel, as opposed to what we have here, is if we have the per units, we just have a cell over here that says anticipated production, 40,000 units or 20,000, whatever it is. And then if sales change and then production changes, it automatically would feed into this and the budget would automatically be updated. The variable costs would be updated based on that new anticipated level of production. Or we can reuse it again for next month and we simply have to review. Did any of those per unit costs change? Otherwise, no. We just change the number of units and everything would automatically be updated for that. Because we talked about on Tuesday the advantages of using a flexible budget over a static budget, and hopefully that is clear why it would be helpful to have a spreadsheet that's going to automatically be updated using that flexible budget formula. So we're told that factory insurance and depreciation are the only fixed factory costs, so we know that those two are going to go down here in the fixed cost area, and these amounts we would expect to remain constant or remain the same within our relevant operating range, and it's the variable overhead costs that would change or vary as our level of production changed. So I can see the factory depreciation there at the bottom of the list. I'm going to have to scroll up to find the factory insurance. There it is. And then all of the other costs that are factory overhead are going to go into this to this top part. So if you do some quick observation here, we only have 5 lines, and in this section we have 10 different items. Now 2 of them went in the fixed overhead. That leaves 8. Only 5 of them, we can tell because we have the template, only 5 of these are going to be factory overhead. So let's take a look at what we have here and see which of these are not part of the factory overhead. Is advertising expense part of factory overhead? Remember the way back in chapter 15 we described what factory overhead means. It's those costs that we have because we're making the product. So if it's a cost that we would have even if we were a merchandising or a retail operation, a cost that is not related to the actual manufacturing of the product, that's not a product cost, it is a period cost. And so advertising expenses are a period cost. They're an operating expense. They are not part of our factory overhead. But manufacturing supplies definitely are part of factory overhead. If we weren't making the product, we wouldn't need supplies for our factory. Now the next line says power and light. I'm assuming, because they aren't specific here, but I'm assuming that that's power and light for the factory. This is not power and light for the office building. That would need to be reported separately as an operating expense. So I'm making the assumption that when it lists power and light here, that is specifically for the factory. Either we have separate meters for the factory and the office, or we have some other way of separating. If we get just one bill for the entire operation, we would need to have some way of separating the part that is for the factory and the part that is for the office.
Could you get a close approximation if you did like total number of hours used and however many hours each was in service and get a proportion off of that.
You could. My guess is you would probably, if you didn't have separate meters, I mean, ideally you just have separate meters. If you don't have separate meters, my assumption is you would probably want to do something like the high-low method to separate out the part that's fixed would probably be the, the baseline, keeping the light, literally keeping the lights on in the building. And the variable part would be the extra power that's being used by the factory. So I think you'd do something like that. There are other costs like heating that you might be able to separate based on square footage. I mean, that would make sense. The same thing could be true. So we have our factory insurance here. If we had just one number for insurance on the building, we would base it, and included the office and the factory. We would base that maybe on the fair market value of the contents of the building and the contents. So the factory with the expensive machines, that's going to be much more expensive to insure than the office building possibly. So we'd come up with a way that's fair and makes sense. It's not a hugely critical difference. There's not just one right answer for how to do that, because either way, the company's reporting the whole expense. So the question really is how much of it is product versus how much of it is period or operating expense. And so nobody's going to get that exercised about, I don't know, I think it should be $1 in the other direction, because either way, no matter how you look at it, the $48,000 for power and light is going to end up as an expense at some point anyway. The biggest issue, I guess, is whether it belongs on the income statement or on the balance sheet, as we talked about absorption and variable costing. That's relevant to that discussion too, because it's all in the overhead category. Under variable costing, it would all go on the income statement in the month it's incurred anyway. But under absorption costing required for GAAP, some of this may end up on the balance sheet in the inventory account. And so that's the only difference that you would see. And that's a temporary difference, a timing difference.
So as long as the whole expense gets reported, where exactly it gets reported isn't like deal breaker, I guess.
Yeah.
Yeah,
because eventually it's all going to be expensed. Yeah, it's
okay.
just a timing difference potentially if our inventory, if we're producing for inventory and we're shifting some of those costs onto the balance sheet, that's the only difference.
Okay.
Our next line is sales commissions. Well, that is not related to manufacturing, that's related to selling. And so that is definitely an operating expense and not included in our factory overhead budget. It would be included in our operating expenses budget, which we also would need to have. The factory insurance was a fixed cost. We've already covered that. Our next two, production supervisor and production control, those are clearly production related or factory related. How about our executive officer salaries? Are those manufacturing? The CEO, the CFO? No. So again, those would go in the operating expenses, they're the administrative budget, but they are not part of the factory overhead. And so our last one then is materials management. Wages of $39,000. So go ahead and find your totals.
Actually, I got 320,000.
Thank you, Seth. Yep. I was doing that in my head and I just carried, I was Still thinking about it. Shouldn't have started writing it till I was sure. Every once in a while, I like to do the math in my head. We get very attached to our calculators, and sometimes we use our calculators for things that we should be able to just do in our head. So, any questions about the factory overhead budget? So now, if we had done these for all the same company, we would have our direct materials, direct labor, and factory overhead, and we could calculate our cost of goods manufactured, what that pro forma or budgeted report would look like. And from that, we can calculate our cost of goods sold, which we then would be able to plug into the income statement along with the sales budget information for the revenues and the operating budgets for the selling, general, and administrative expenses. And we'd be almost to the end of the budgeting process. As we mentioned last class, the master budget includes all of those operating budgets. And then we have our pro forma or budgeted financial statements at the end. So all of these operating budgets are contributing to that budgeted or pro forma income statement. Questions, anybody? So let's keep going. Next, we have our cost of goods sold budget. So I already mentioned, in order to do the cost of goods sold budget, we need to have already in place the direct materials, the direct labor, the factory overhead budget. We need to know our beginning and ending inventories so that we can take those into account as well. And then we can do our cost of goods manufactured and our cost of goods sold budgets. Delaware Chemical Company uses oil to produce two types of plastic products, P1 and P2. Delaware budgeted 35,000 barrels of oil for purchase in June for $90 a barrel. Good luck. 2 years ago, I would have been saying, boy, that's really high. Now it's bargain price. Direct labor budgeted in the chemical process was $240,000 for June. Factory overhead was budgeted at $400,000 during June. The inventories on June 1st were estimated to be, we have our budgets there for the raw material, oil, plus the two finished goods, P1 and P2, and then we have our work in process. And we have those same information for desired ending inventories as well. Use the preceding information to prepare a cost of goods sold budget for June. Please note, for those boxes in which you must enter subtracted or negative numbers, use a minus sign. So again, this is one of those times they're telling us, pay attention to the negatives. So we have P1 and P2, but our budget, our cost of goods sold budget, is actually going to look at these in combination. So we're not doing a separate budget for P1 and for P2. So keep that in mind. We're going to be combining them. This is the entire cost of goods sold budget. So we'll start with, what do we have at the beginning of the month? Our finished goods inventory. So here's our inventory. So here's the beginning of the month, our finished goods inventory, $8,300 worth of P1 and $8,600 worth of P2 for a total of $16,900 worth of finished goods inventory. What did we add to it? Okay, so this next section from here down to here is going to be, what did we add to that inventory? So what did we do during the month? So we start with our work in process at the beginning of the month. We had $12,900 worth of inventory in process. Why did they, up here, why did they not give us a separate number for P1 and P2? Well, it might be, if you think back to that joint cost, the chapter in joint cost allocation, it might be because they all start from crude oil and we separate the crude oil into two different products, or we make it into two different products. It could be at this point, it's still all one stream of product, and event, once it splits off, then we have distinct P1 and P2. So that could be why they're giving that to us as one combined number. So that's what we started with. We're now looking at, if you think back to the flow chart that I have in Blackboard for you, where we have all of those inventory accounts and the arrows going here, there, and everywhere to show you the flow of costs in and out of that work in process account. That's what we're doing right now. We're looking at the work in process inventory account. This is what we started with. Now, what did we add to it? So what did we add to it? Direct materials. So at the beginning of the month, we had direct materials, that's the oil, of $15,200. That's given right, whoops. Yeah, it's that top number for some reason. There we go. $15,200. How much did we add to it during the month of June? Or what did we purchase? Here we are. We have budgeted to purchase 35,000 barrels at $90 a barrel. Our budget for purchases, $3,150,000. Now, in this circumstance, we have a very, we're already given that number. We only have one direct materials. We talked about how we simplify things. How did they know that they were going to purchase 35,000 barrels of oil? Because they already did the direct materials purchases budget. So it's feeding into this cost of goods sold budget. They already have calculated that. So how much did we have available for use based on what we started with, 15,200, and what we anticipate purchasing? We expect to have available for use in production $3,165,200 worth of oil, that raw material. And how much do we expect to have on hand at the end of June? We are told the desired inventory is 16,100. So that's material that we aren't going to be using. And remember, we are told, we are directed to use the negative. So in this case, did I copy that right? 16,100. 16,100 is what we need to have, or what we want to have left. And so the difference would be how much we actually used, or how much we actually plan to use. So again, we're analyzing the flow of costs through that work in process inventory account. We have now determined, calculated, how much direct materials will get added to that work in process. What are the other two pieces? Direct labor and overhead are also going to be added to that work in process account. And the direct labor is given to us. Direct labor is budgeted to be $240,000. How do they know that? Because they've already done the direct labor budget. They've already figured out how much labor, all the different types of labor that go into producing this product or these products, P1 and P2. They've already done the calculation, the budget for how much of each of those direct labors, how many hours do we need, how much are we going to pay them? And so that is feeding in from that direct labor budget. And factory overhead is budgeted at $400,000. Just like we did in the last exercise. How do they know that? Because they've done the budget. And so those three, nope, sorry. That's the number I want, or that's the title I want here. Total manufacturing costs added to work in process during the month. It's the direct materials placed into production, the direct labor, and the overhead. And I just so the total manufacturing costs are what did we add to the work in process account during the month? It's the sum of the direct materials, the direct labor, and the overhead. Total work in process during the period. We'll add the beginning inventory to that number. Add the beginning inventory, 12,900, plus those costs added during the month. The total work in process during the period was 30, or would be, this is a budget, would be $3,802,000. And at the end of the month, we expect to have work in process remaining of $13,500. So again, because we're going to subtract that, it does direct you to use the negative, and it will mark it wrong if you do not use the negative. So that's our work in process at the end of the month. If we subtract that from the total work in process, we will have our cost of goods manufactured, the dollar value of the product that is finished up and moved on to the next step in the process, or to finished goods. Now remember, what we're calculating here is cost of goods sold. So we know now what we started with in finished goods inventory. We know what we expect to add to it. So if we add those two together, that will tell us the cost of finished goods available for sale, what we started with and what we expect to add to it. Beginning inventory, remember, was the combination of P1 and P2 all the way up here, plus what we added to it, direct materials, direct labor, and overhead. We have throughout the month, at some point, we have a total of or expect to have a total of $3,801,400. But we do not
I got 3805,400.
Yeah. Yep, I agree. 3805,400. Yep, I agree with that number. We don't expect to sell all of that this month. We do expect to have some finished goods inventory at the end of the month. And right here, we are told how much that is. And just as we did at the top, we are combining those P1 and P2. And because we're going to subtract that, make sure you put in the negative. And finally, we have our cost of goods sold. Seems like a lot of work, seems like a pretty long schedule here, but keep in mind all of the work that went into coming up with the numbers that are going to feed into this schedule. We needed to have our direct materials purchases budget. We needed to have our direct labor budget. We needed to have the factory overhead budget. We needed our production budget before we could do any of those. any questions about the cost of goods sold budget?
Kind of to ask a question, Are we gonna have any of these on not the next test, but the test for this chapter? Where it's so many fields,
Maybe?
okay. Because it just, looking at all the fields we're required to put in,
Mhm.
I'm just wondering how I can help myself remember what exactly goes where.
Yeah, so you can I don't know if you can hear the question in the classroom, but the question in the classroom is, would we expect to see something like this on our next exam? So not exam 2, but on exam 3 that includes this chapter. And I honestly don't recall exactly what's on that exam. As always, we can take a look at it as the exam gets closer. It's still a couple weeks away. But I think it's fair game. And so the follow-up question is, how do I remember the order here? And I have 2 suggestions. One is that you use your textbook to find because there are absolutely examples of this in the book. And so follow along with that template that you have in the book. Or all of these exercises are printable. So if you think that having something like this in front of you, or even just taking a screenshot and having that screenshot saved, because I'm not sure you can, I don't think you can probably don't think you want to. I would prefer you did not leave the exam to go look at the exercises. So anything like this that you think you might want to have as a reference, either screenshot it and have that available, or find it in the book, know where they are in the book.
So then pretty much any cost of goods sold budget, at least that we're gonna encounter in chapter 22 and or test 3 should follow the same.
Yeah, this is the generic format. So, and it is, to think back, excuse me. Trying to remember which folder it's in. Yeah, so it really is what we did here. This is in the chapter 15 folder, my whiteboard scratch. So it's this calculation of cost of goods sold, but what we did only included this part. So it didn't even include the analysis of the materials inventory. We already had that materials piece, but we did everything that happened in work in process to find the cost of goods manufactured, and then we did what happened in the finished goods inventory. So very standard format here. And I don't expect you to memorize everything here, but you might want to have something like this available for reference. And I'm not positive what's on that exam. I would need to look at that, and we're not going to do that right now, but we can do that as the exam gets closer. Okay. So we've talked our way through the entire set of operating budgets, and we are now at the point that we can do the pro forma financial statements. So one of the most important forecasting tools we have is a cash budget. So we need to remember way back in chapter 1 in financial accounting, we mentioned, you would have read at that time months and months ago. For most of you, that was like last August, right? So the 2 main goals of any business are liquidity and profitability, making money and paying your bills on time so you can stay open. The cash budget piece of that speaks directly to the liquidity question. Do we have enough cash to pay our bills? If not, what plan do we have? Whether it means having a line of credit or something like that, open at our bank. We need to plan for the timing of our cash. So the difference between profitability and liquidity, in simple terms, is profitability is based on accrual accounting. So we record revenues when we've earned them, regardless of whether our customers have paid us. And we record expenses when they go with the revenues, regardless of when we pay for them. So sometimes we pay up front for things like rent and insurance. And sometimes, as we're going to see in this exercise, the timing of the cash flows from our customers doesn't match up with the revenues either. And that's always going to be the case when we allow customers to buy on credit. So that's what we're dealing with here. How do we plan for, how do we plan for collecting cash from our customers? Because it's not when we've earned the revenues, it's when we have the cash. And so we're going to do a schedule here based on our sales. And again, these are projected sales because we're in the budgeting chapter. So we're a brand new company. You can see in the first month of operations, we expect to sell $300,000 worth of pet supplies. And then each month our business is projected to expand. Well, we know when we sell on credit, we know that we're not going to be collecting that money at the same time we make the sale. You'll notice it does tell us here 75% of the sales we do expect to collect in the month of the sale, 20% the next month, and then the following 5% 2 months after the sale. We're not going to really talk about it here, but I just want to remind you of something we discussed in chapter 8 in financial accounting, which was on receivables. And there's a little bit of a problem here that they haven't taken into account, because if you add these percentages up, 75 plus 20%, and then it says the remainder, the last 5%, will also be collected, but we have to wait 2 months to get it. They're not taking into account the risk that we may not collect all of these sales. So this company already, in my opinion, and I know they're just simplifying it because this is managerial accounting, not financial accounting, but I'd like to be realistic and recognize that by extending credit to all of our customers, we take a risk that some of them may not pay us, may not be willing or able to pay us. And this company is not building in that uncollectible accounts piece, the allowance piece. So in my opinion, they missed an opportunity here with this exercise, and they should have said something like 3% is collected in the second month following the sale, and the other 2% is expected to be uncollectible. I would prefer that they did something like that to be a little bit more realistic, because in our budgeting, we want to be conservative. We don't want to miss our cash targets because, oh, we didn't realize or we didn't plan for some of our customers not being willing and able to pay. So let's start with January sales. We have $300,000 we anticipate in sales in our first month of business, and 75% of that, or $225,000, we expect to collect in January. Another 20%, or $60,000, we expect to collect in February from January sales. And then the final amount, the last 5%, or $15,000, we expect to collect in March. So our income statement for January is going to show $300,000 in revenues or in sales. But our cash is only going to be $225,000. What's the problem here? A mismatch between our income when we report the revenues and our cash, our liquidity. So think about the issue, the potential problem here, that our suppliers might want to be paid in January. If we're a brand new company, they might not be too keen on giving us a lot of time to pay because we don't have a track record. We don't have a credit rating per se yet. And so we need to have the cash available. We may need to consider other sources for cash, which again might include a line of credit or a cash infusion from investors or something like that, to make sure that we can continue to pay our bills, pay our suppliers so they'll still sell us stuff, pay our employees so they still come to work, pay any taxes that might be due, pay our attorneys that helped us with setting up the company, and so on. Let's go on to February. $500,000 in February sales. And we expect to collect 75% of that, or $375,000 in February. And another 20% in March. And the last 5%, or $25,000, we're not showing on this chart because it will be collected in April. And we're only budgeting here for the first quarter of the year. Moving on then to March, our sales continue to grow in our budget, which if that's true, that's a very positive thing for us. But as our sales grow each month, the situation gets a little bit more amplified, that now we have $750,000 in sales, but only collecting cash from those sales, $562,500. The rest of it, based on the information given, we will collect in April and May, but we need to be planful to make sure that we can meet our expenses, meet our liquidity expenses, or liquidity needs, excuse me, until things, whoops. I'm still working out my new calculator. And so in that final month of our budget in March, our sales are $750,000. Even though we have that collection coming in from 5% of January sales, 20% of February sales, we still aren't even bringing in as much as our sales are in those cash collections. Now, if we continue to grow, this situation will continue. But as things presumably will level out, we'll eventually catch up with that, and we will have a good match between what's coming in and what's going out. But you can see why the majority of businesses go out of business in the first 6 months of operations, and that's because, in part, because of what you're seeing here. It may be a fantastic business idea, but they underestimate their cash needs, and they go out of business not because they can't be profitable, but because liquidity is an issue, because they can't pay their bills. And so their employees stop coming to work, their suppliers stop selling them stuff. And so that is the main problem for new businesses, and the reason most of them don't stay in business. It may have nothing to do with their business model, in other words, what they're selling, and everything to do with their liquidity issues. Could be their business model. Maybe they're selling something. I'm saying that never happens. Clearly, people start businesses that don't work out for a variety of reasons. But a main problem is related to liquidity. Okay. So what we were just looking at in exercise 8, any questions on that? Definitely important to keep that in mind. As we look at exercise 9, then we're now looking at the flip side of that coin. So in exercise 8, we were only looking at cash inflows, and now we're going to look at cash payments, specifically for selling and administrative expenses for this particular company, Horizon Financial Incorporated. It is a service company. So as we frequently do at the end of each chapter, we get to how did what we just talked about in this chapter, how can that be used by companies other than manufacturers? In reality, our last exercise, this is also not a manufacturer. It says they're a wholesaler. So now we're looking at the rest of that cash budget. So the cash budget is going to include both cash inflows as well as cash outflows. And to assess whether our cash needs, we're going to be comparing, well, how much is coming, how much do we think is coming in? We want to be conservative with that. We don't want to overestimate the cash that will be coming in. We don't want to overestimate in the last exercise when we're selling on account. We don't want to overestimate when our customers are going to pay us or if they're going to pay us. And now we're going to be looking at the cash outflows side. Horizon Financial Incorporated was organized on February 28th. Projected selling and administrative expenses for each of the first 3 months of operation are as follows. Depreciation, insurance, and property taxes are 9% of the estimated monthly expense. The annual insurance premium was paid on February 28th. Property taxes will be paid in June. So those pieces, the insurance and property taxes, are not going to be paid in this quarter, March, April, May. One was paid in February, the other will be paid in June. They don't tell us about depreciation though. Why don't they tell us how much the depreciation is? How does depreciation play into our cash payments budget?
Does it?
It doesn't. Yes, that's the correct answer.
Just a negative valuation, right?
Yes, so depreciation is a non-cash expense. It shows up on our income statement, but thinking back to financial accounting, chapter 9, when we talked about long-term assets and depreciation, depreciation is that accounting technique that we take the upfront cost of those assets and spread it out over your expected useful life. So depreciation does not play into our cash budgets at all because it is not a cash expense. Insurance and property tax, yes, are cash expenses, but they're not part of this quarter because one was paid in February for the annual amount. It won't be due again until next February. And the other is also an annual amount and it won't be paid until June. Okay. So for each one of these amounts, we're going to be subtracting 9,000 off the top because those are numbers that are not going to be included. When we talk about expenses, expenses means what's helping us to generate revenues, and that would include accrued amounts. This is what's going to show up on our income statement. So it would include accruals for the monthly part of the insurance, the monthly part of the taxes, and the monthly depreciation. But we're going to be subtracting $9,000 from each one of those because they don't impact our cash in this quarter or at all in the case of depreciation. Of what's left then, 70% of the remainder are expected to be paid in the month in which they are incurred, and then the other 30% will be paid the following month. So for March's cash expenses, we'll start with the $52,400 given there, but we're going to subtract the $9,000 that is the depreciation, insurance, and property taxes. So only $43,400 in expenses that we expect to pay in cash during this quarter. And of those, 70% will be paid in March. And the other 30% paid in April. Make sense? Okay, let's go on to April's expenses, $64,200, but we need to subtract the $9,000 that's not cash in this month. 70% of that will be paid in April. Brand new company, they're growing, so each month their expenses are going up. Hopefully, we would expect their revenues are going up at the same time. Oops. And finally, May's expenses minus the $9,000. 70% of that we would expect to pay in May. The other 30% is going to carry over to June's budget, which we are not doing right now. Okay. Questions about that? Okay. So of course, these two pieces, if these were the same company, these two pieces need to be looked at in tandem. Here's what we have coming in each month. Here's what we expect to have going out each month. What's the difference? Do we have an expectation of a minimum cash balance we want to keep on hand? Do we need to be ready to tap that line of credit or however else we're going to cover those cash needs if we have them?
Would we have the two separate reports, or would we kind of throw it together?
It'd be all one report with the cash inflows, outflows. Here's the scenario. Are we looking at needing to borrow or access some other cash infusion? Okay, so our last exercise, not forgetting about exercise 5 that we skipped over because it was review of production and direct materials, I think it was. So you will have to go back and do that. But our last exercise of new information. So I mentioned on Tuesday the concept of a capital expenditures budget. The capital budgeting process for most organizations is different and maybe wholly separate from their operating budgets. Capital expenditures are things that are going to be around for more than 1 year. So things we're going to capitalize, put on the balance sheet, and they are subject to depreciation or some kind of a long-term writing off of those amounts. This is how the capital budgeting process frequently happens at organizations. They put out a call for, what do you need? What do you need to run your department or to run your program or to run your whatever? And so people put in requests, capital requests. We really need to replace the computers in the Tech 207 lab. Not really, because these are less than a year old, I think. We really need to look at replacing the roof this year, and here's how much we think it's going to cost. And so they're soliciting proposals, if you will, for what do we need to be more efficient or to undertake some new project or to keep things up to date. And then they compare those needs and they're going to prioritize them, and the company will consider how much money do we have available for these capital expenditures. How many of these are mission critical? Should we consider borrowing money if we don't have the capital of the financial capital available to pay for them? And so in this exercise, we're given a whole bunch of information. We're going to come back. We're going to go through each one of them one at a time, but I want you to see what the format looks like. So we're going to be looking at possibly funding 3 different capital projects, and the timing of those cash flows, for each of those three projects will be over the next 4 years. On January 1st, 2016, the controller of Omicron Incorporated, written long before there was such a thing as the Omicron variant of COVID virus, and there's totally no connection there, is planning capital expenditures for the year 2016 through 2019. The following interviews helped the controller collect the necessary information for the capital expenditures budget. The director of facilities said, a construction contract was signed in late 2015 for the construction of a new factory building at a contract cost of $10 million. The construction is scheduled to begin in 2016 and is completed or will be completed in 2019. The VP of manufacturing said, okay, once we have that new building, which isn't going to be completed until 2019, we plan to purchase $1.5 million in equipment in late 2017. I expect that an additional $200,000 will be needed early in the following year to test and install the equipment before we can begin production. If sales continue to grow, I expect we'll need to invest another $1 million in equipment in 2019. The CFO said, the COO, excuse me, we've really been growing lately. I wouldn't be surprised if we need to expand the size of our new factory building in 2019 by at least 35%. Fortunately, we expect inflation to have minimal impact on construction costs over the next 4 years. Additionally, I would expect the cost of the expansion to be proportional to the size of the expansion. So another 35% on top of the initial $10 million in building costs. The Director of Information Systems said, well, we need to upgrade our information systems to wireless network technology. It doesn't make sense to do this until after the new factory building is completed and producing product. During 2018, once the factory is up and running, we should equip the whole factory with wireless technology. I think it would cost us $800,000 today to install the technology. However, prices have been dropping by 25% per year, so it should be less expensive at a later date. And the CFO then, final interview. I'm excited about our long-term prospects. My only short-term concern is managing our cash flow while we expend the $4 million of construction costs in 2016, $6 million in 2017 on the portion of the new factory building scheduled to be completed in 2019. Use this interview information to prepare a capital expenditure budget. So we have 3 things that we're budgeting for: building, equipment, and information systems. And we'll see, I may have those in the wrong order, but let's go through what our expenditures are expected to be. So we're told right here for the building, $4 million in 2016, another $6 million in 2017, and then what did the CEO, wait, where is it here? Yeah, the COO right here said they're going to need to expand that building. The year it's done, they're already going to need to expand 35%. And they expect the cost to be proportional to that 35%. So that's 35% of the initial $10 million in cost. So the building, I did have it on the right line because we have expense related to the building in 2016, 17, and then in 2019 when they expand. 35% of the original $10 million for that building. What are we told about equipment? The VP of manufacturing said once the new factory building is finished, we plan to purchase $1.5 million of equipment in late 2017. I expect an additional $200,000 will be needed in the following year to test and install the equipment. And then if sales continue to grow, we'll need another $1 million in 2019. And finally, the Director of Information Systems says, right now, the wireless technology would cost us $800,000. But we don't need to do it this year. We'll do it when we finish the building. So we're gonna put it off. So if we were to do it next year, it would cost 25% less, or only 600,000. And if we were to put it off one more year, it would cost 25% less than that. So it's not half the original price, because they're dropping 25% each year. And so we take 25% off for the first year, and then 25% off that for the second year. Now, I would like to suggest that there's something a bit unrealistic about this. Either that or this company is just swimming in money and maybe not a lot of common sense. Because we just built the budget based on the wish list of these individuals. And I would suggest that in most companies, that's not how it works. We solicit, what do you want? And what can you live with? We need you to get the job done, but rarely in my experience do you get everything you ask for. But we have our budget here. Capital budgets do tend to be more long-term because the projects you're investing in are, as you can see with this example, are long-term in nature. The budgets we worked on up to this point are all more short-term operating budgets where our time horizon is generally 1 year or even less as things continue to change. All right, so any questions about that, about the budgeting chapter? Okay, so we have about 7 minutes left in our regular class time. I would suggest that you can take this time to go back to exercise 5 and finish that up, or finish that up at your convenience. And if there aren't any questions, I am going to stop the recording at this point.
I do have a quick question on exercise 5.
Okay.
For part B, is that going to be, so at least for the top part, is that going to be copied from the table, or is that per the number of units produced, or per?
So the direct labor budget would be based on the number of units that you would produce. Yes.
Okay.
Is that what you're asking?
Yeah.
Yeah.
So.
Yep. Okay. Any other questions before I stop the recording? All right. Well, thank you for being here. Happy St. Patrick's Day. Good luck on the exam this weekend. If you have any issues, let me know, and I will see you Tuesday.